let's jump right in. Welcome back to The Explainer. Companies absolutely love to brag about their top-line revenue and their skyrocketing sales. But consider this. Cash flow bottlenecks, not a lack of sales, are the reason over 80% of businesses actually fail. Because, well, a sale isn't truly a sale until the cash is literally in the bank. Today, we're unpacking accounts receivable and credit losses, or what I like to call the cost of doing business. It might sound like standard accounting, but the real-world mechanics behind this literally dictate whether a company thrives, barely survives, or completely goes under. Let's get into it. So think about this for a second. What actually happens to a business when a guaranteed future benefit just suddenly disappears? Think about the life or death stakes here. Imagine your enterprise has done all the hard work. You manufactured the product, you delivered the goods, or you provided a top-tier service. You sent the invoice and you're banking on that cash coming in. In fact, you've probably already penned it into your budget to pay your own team and your own suppliers. But then, poof, the customer defaults. The money's just gone. This isn't just some theoretical textbook scenario. This is the very real danger of doing business on credit. Okay, let's dive into this by first looking at the optimistic foundation of our journey, accounts receivable. This is way more than just a line item. It's an asset created by selling goods and services on credit, and it forms the absolute backbone of modern economic activity. Selling on credit isn't the exception. It's the rule. It's the grease in the wheels of commerce. Most business-to-business transactions work exactly like this. You buy now, and you pay in 30, 60, or 90 days. It is essentially trust, formalized right onto the balance sheet. It's the promise of future cash that keeps the whole economic engine running smoothly. But for that trust to actually count as a concrete asset on your books, it has to pass a pretty strict litmus test. First, it must be a resource-controlled, meaning you have a legally enforceable right to collect that specific amount from a customer. Second, it has to stem from a past event. You can't just book an asset for a sale you're hoping to make tomorrow, right? It has to be a credit sale that already happened. And finally, and crucially, there must be future economic benefits. In plain English, there has to be a highly probable expectation that you're actually going to get that cash down the line. If you don't realistically expect the money, you don't have an asset. You just have a wish. But what happens when that trust is broken? Well, the verdict is harsh. A direct decrease in future benefits. If a customer defaults on what they owe, maybe they went bankrupt or maybe they just disappeared entirely, that promised cash vanishes into thin air. That future economic benefit you were legally relying on, officially gone. And the court of financial reality says you can't just pretend it's still coming. You have to deal with it on your books right then and there. So how do we formally recognize this financial pain? We do what accountants call writing off bad debts. When a specific customer defaults, we simply write it off. We debit our credit loss expense, which takes a direct, immediate hit to the year's profit, and we credit accounts receivable to wipe that empty promise right off the books. It's basically the corporate equivalent of finally accepting that your buddy is never going to pay you back for that expensive dinner and officially removing it from your mental ledger. Now, this brings us to a really fascinating shift in financial strategy. You're basically comparing two completely different mindsets here. On one hand, you have writing off bad debts, which we just talked about. That's dealing with actual customer defaults after they happen. It's purely reactive, and it creates these unpredictable, sudden shocks to an income statement. But on the other hand, you have a much more sophisticated approach. Creating an allowance. This is where a company proactively looks at its entire pool of receivables at the end of the period and estimates future unlikely receipts before any specific customer actually defaults. It's the proactive strategy of anticipating the pain before it ever catches you off guard. And this brilliantly illustrates the massive, heavy burden an enterprise carries when assessing the actual cash that will flow to them. At the end of every single accounting period, management is tasked with carrying this heavy load. They have to sift through all their outstanding invoices and critically evaluate, out of all these heavy receivables we're carrying around, how much of this cash is actually going to make it through our front door. Because let's be real, management knows not every dollar is going to be collected, so they create an allowance for doubtful debts. They make a calculated estimate at the end of the period of the amount unlikely to be received. And the really crucial point here is that this provision isn't just a random guess scribbled on a notepad. It's a formal, required adjustment to the carrying amount of accounts receivable on the ledger. We record it with a crucial entry. We debit the credit loss expense to take the hit on our own terms, and we credit the allowance for credit losses. This allowance acts like a financial shield. It holds all our anticipated bad news safely, keeping the net value of our assets grounded in reality, without having to wait for a specific customer to formally default. Let's walk through the exact step-by-step procedure used to adjust this allowance. It turns a complex accounting rule into a digestible business survival skill. Step 1. Make a current estimate of today's economic reality. Are your customers struggling right now? Is the broader economy dipping? Step 2. If the risk of default is higher than you previously thought, you increase the allowance. You debit your credit loss expense and credit the allowance to build up a thicker safety net. But look at step 3. This is the one management absolutely loves. If things are actually looking surprisingly good, and you overestimated the bad debts in the past, you can decrease the allowance. You debit the allowance account, which effectively reduces your previously recorded expenses and gives a nice unexpected bump to the bottom line. It's a continuous, living adjustment perfectly matched to the current reality of your business environment. Which brings us to our final and perhaps most provocative question. Is your enterprise, or the ones you invest in, accurately assessing the future economic benefits that will actually flow to them? Are they wearing rose-colored glasses, assuming every single invoice gets paid in full? Or are they proactively and realistically preparing for the inevitable credit losses that just come with doing business? You see, understanding accounts receivable and meticulously managing credit loss isn't just some chore for the accounting department. It is the absolute heartbeat of financial resilience. Thanks so much for joining me on this explainer today. Keep learning, keep asking those hard questions about where the cash really is, and I'll see you in the next one.